This is a quick sound check. Please type yes in the question box if you can hear me. Full year results. Please note, I will not handle any questions during the webinar, but feel free to ask questions which I will then respond to via email. Here's a quick look at what we will be covering today. I will start with the nature of business, followed by the recommendation, the financial review, portfolio review, divisional review, corporate actions, company guidance, and portfolio guidance. Taking a look at the nature of business, Redefine is a leading South African-based real estate investment trust with a portfolio valued at 84.1 billion rand. Redefine holds assets in South Africa, the UK, Poland, Germany, Africa, and Australia. The group has exposure to retail, office, industrial, student accommodation, and hotels, with retail and office assets making up majority of its portfolio. Now taking a look at the recommendation. We feel the share is fairly valued, trading at a small premium to its 12% historic discount to the long bond yield rate. The discount to the long bond yield rate recently narrowed due to Redefine's increasing offshore exposure. Management have lowered their 2018 distribution growth guidance from the range of between 7 and 8% in 2017 to between 5 and 6%. The group's NAV declined by 3.1% due to impairments and financial market volatility. However, some of the decline in NAV due to the currency's strength has been reversed to date. The share is currently trading at a 4.4% premium to its NAV of 10 Rand and 22 cents per share. Redefine reported a higher loan-to-value ratio of 41.1%, owing to the group's high levels of debt in its offshore operations. The loan-to-value ratio on their local portfolio was 34.5%. On a see-through basis, the loan-to-value ratio is high at 50.2%. The group's listed investments contributed 20% to its total assets. The retail and office sectors, which when combined make up 78% of the group's portfolio, are currently under pressure. Management plan to further diversify into higher yielding, non-traditional asset classes with a focus on student accommodation. The share is underpinned by an attractive dividend yield of 8.6%. Now moving on to the financial review. Total revenue was up by 17.3%, supported by quality acquisitions. Operating costs were contained at 34.2% of the group's contractual rental income. Finance costs rose by 24.3% to 1.7 billion, impacted by an increase in debt. The group declared a final dividend of 47.18 cents per share, up by 6% from the previous period. This brings the full year dividend to 92 cents per share. This represents 7% year-on-year growth, which is in line with management's previous guidance. NAV declined by 3.2% to 10 Rand and 22 cents per share. Now taking a closer look at NAV. The NAV was adversely impacted by the revaluation of interest rate swaps, which detracted 11.8 cents per share, an impairment of associates, which detracted 23 cents, and forex losses on equity accounted investments, which detracted 27.5 cents from the group's NAV. Taking a look at the group's portfolio. Redefine's local portfolio was valued at 68.1 billion, while the group's international portfolio was valued at 16 billion, of which 14 billion is related to listed assets and 2 billion is related to direct properties. International assets represent 19% of the overall portfolio. The group's international portfolio exposes them to the British, Australian, African, and Polish markets. On a geographical basis, majority of the group's assets are situated in South Africa. Majority of the local portfolio assets are situated in Gauteng, followed by Western Cape. The active portfolio vacancy rate declined marginally to 4.6%. Leases covering 530,000 square meters were renewed at an average rental increase of 2.9%. Tenant retentions remained high at 92.6%. Net arrears rose to 67.9 million, representing 7.5% of gross monthly rental. This was driven by the Pivotal acquisition. Now moving on to the divisional review. Retail contributed 40% to the portfolio value. The value of the retail portfolio rose to 26.2 billion, while the gross lettable area increased to 1.4 million square meters. The retail portfolio is predominantly made up of regional centers, making up 30%, followed by small regional centers making up 24%, and super regional centers making up 17%. Majority of the retail assets are situated in Gauteng and Tshwane. Vacancy rates improved marginally to 3.3%. Tenant retention by gross lettable area improved to 93.6%, while the renewal rental growth rate declined from 6.5% in the previous period to 2%, which highlights that securing tenants continues to come at the price of lower rentals and lease terms which better suit retailers. Trading density growth fell to 0.4% from the 5.4% in the previous period. Footfall growth was down by 0.1%. Management expect that competition for market share will intensify and have highlighted focus areas to help mitigate the impact of this, such as optimizing space, securing the right tenant mix, investing in security enhancements, and offering parking rates which promote dwell time. Now moving on to offices. This division contributes 38% to the portfolio value. The value of the office portfolio rose by 24.5% to 23.3 billion, while the gross lettable area of the portfolio was up to 1.4 million square meters. On a geographical basis, the office sector has the largest exposure to Sandton, followed by Western Cape, and then Pretoria and Centurion. The office portfolio is split by grade as follows. P grade makes up 40%, A grade makes up 36%, B grade 17%, and C grade 7%. Vacancies remain high at 8.1%, although show some improvements from the 8.7% in the previous period. Vacancy rates on P and A grade properties was 4.3%, down from the 6% in the previous period. The tenant retention rate, based on GLA, declined to 87.1%, while the renewal rental growth also deteriorated to 0.1%. The office space continues to experience oversupply and remains a tenant's market. Flexi hours and hot desking have been key drives in the reduction of space required in the sector. Redefine experienced healthy demand for office space in prime nodes. Management have highlighted that tenant retention is a key priority. The group will focus on continuously rejuvenating their office properties to ensure relevance in the market, and will also look at increasing the number of Green Star rated existing buildings. Now moving on to industrial. This division contributes 14% to the portfolio value. The industrial portfolio value grew marginally to 11.2 billion, while the gross lettable area was up to 2 million square meters. The industrial portfolio is split by grade as follows. Heavy grade industrial making up 40%, modern logistics 29%, light manufacturing 12%, MIDI units 10%, and warehousing 9%. Vacancies improved to 3.3%. Tenant retention based on GLA improved to 95.2%, while the division achieved renewal rental growth of 5.6%. Management have highlighted that location, efficiency, and accessibility are key drivers of demand. Larger tenants are looking to co-own properties. The group will remain focused on improving its industrial facilities to retain tenants. Now looking at the other components of the portfolio. Student accommodation contributed 2% to the portfolio value. This division has a current bed capacity of around 5,900 beds, and they plan to increase this to 10,000 beds by 2019. The group will focus on the conversion of suitable located secondary assets. Hotels contributed 2% to the portfolio value, and specialized and loans contributed 4% to the portfolio value. Moving on to corporate actions. During January 2017, Redefine acquired 100% of Pivotal shares in issue. This transaction was completed via the issue of 460 million Redefine shares to Pivotal shareholders. Redefine acquired Pivotal's property portfolio valued at 10.4 billion rand, which comprises of 17 office, 5 industrial and 10 retail properties, with a total gross lettable area of 437,000 square meters. Student accommodation. Redefine acquired a 90% equity investment in Journal Student Accommodation Fund in operations, based in Melbourne, Australia. The 804-bed development in Leicester Street commenced during June 2017. Redefine's share of this development is estimated at 1.3 billion rand. Another site was acquired which offers capacity for at least 650 beds. Disposals. The group disposed of 25 properties with a total gross lettable area of 259,000 square meters for a total consideration of 1.9 billion at an average yield of 8.4%. Looking at developments and extensions, the group completed developments valued at 3 billion with an average projected initial yield of 8.4%. Now moving on to company guidance. The group has adapted its strategy to cope with the weak consumer and business confidence and the prolonged slow growth environment. Redefine will focus its resources on the expanding and improving of its existing well-located local properties. The group will recycle secondary assets to position the local portfolio for future growth, and will also look at opportunities to acquire selected assets in underrepresented regions. Redefine will look at growing their non-GLA revenue streams to 100 million in the near term. The group will remain focused on expanding geographically where attractive yield spreads are offered. Now moving on to the portfolio guidance. We feel the share is fairly valued at current levels and would recommend a portfolio exposure in line with the benchmark weight. Redefine's weight in the JSE Capped Swiss Index is 1.01%. Before we end off, please take note of the following disclaimer. Thank you. That concludes the end of my webinar. Should you wish to ask any questions, please type them in the chat box. Should you wish to place a trade, please feel free to contact our trading desk. Thank you for listening and enjoy the rest of your day.